7 money rules change on July 1st, and the average Aussie who ignores them leaves up to $700 on the table this financial year. That's not a scare number. It's the combined tax cut, super cap boost, and deduction change most people won't claim properly. I'll walk you through every single one. Some of these changes hit your bank account automatically. Others need you to act before you lodge. Pick the wrong option on even one, and you could end up worse off than last year. I'll show you the new no receipt deduction and why it's actually a trap for millions of workers. I'll break down the biggest change to super in 20 years that starts building your retirement faster this month. And I'll get to the new tax on super that charges you on money you haven't actually received in cash, something almost nobody is talking about. Stay with me through all 7, because 3 of these changes require a decision from you before your next tax return. And the difference between knowing and not knowing is hundreds of dollars. Let's start with the easiest one. From the 1st of July 2026, the tax rate on income between $18,201 and $45,000 drops from 16% to 15%. That saves you up to $268 a year, about $5.15 a week. Not exciting, but it's completely automatic. Your employer adjusts the withholding and you just see slightly bigger pay every fortnight. Now here's where most people check out. $5 a week sounds like nothing. But this same bracket drops again next year to 14%. That doubles the saving to $536 a year. So over 2 financial years, you're looking at more than $800 in tax cuts without lifting a finger. Every other bracket stays exactly the same. 30% up to $135,000. 37% up to $190,000. 45% above that. This cut specifically targets workers earning under $45,000. If that's you, the money's already on its way. Now for the change everyone's been talking about, the $1,000 instant tax deduction. No receipts needed. Sounds like free money, right? But do you actually know the difference between a deduction and a refund? Because that gap is about to cost a lot of Australians real money. A $1,000 deduction does not put $1,000 back in your pocket. It reduces your taxable income by $1,000. For someone on the 30% marginal rate, that means roughly $300 back at tax time. Not $1,000, $300, and it gets worse. If you already claim more than $1,000 in real work expenses, uniforms, tools, car travel, working from home costs, self-education, this standard deduction gives you less money back. You'd be swapping your real receipts for a smaller flat amount. That's not a simplification. That's a downgrade. The ATO gives you a choice. Take the standard $1,000 deduction or itemize your actual expenses. You cannot do both. So before you celebrate, check last year's return. Look at your total work-related deductions. If they're above $1,000, keep every receipt you've got. The standard option is a pay cut, dressed up as convenience. One more thing on this. It's not even law yet. It still needs to pass Parliament. And it applies from the 2026-27 income year. You won't claim it until you lodge in 2027, not this tax time, next. Now this is where it gets serious, because the next change is worth more than every other one on this list combined over a lifetime, and barely anyone is paying attention to it. If you stop watching now, this is the part you'll wish you hadn't missed. From the 1st of July, your employer has to pay your super every single payday. Not quarterly, every single pay run. And it has to reach your fund within 7 days. Sounds like a boring payroll change. It is the opposite of boring. Here's the maths. Under the old quarterly system, your boss could hold your super for up to 3 months at a time. That money sat in their business account. Not invested, not compounding. Earning you absolutely nothing while they used it as free cash flow. Now multiply that across every quarter, every year, for a 30-year career. You're looking at somewhere between $10,000 and $20,000 in lost compound growth. Gone, just because your money was sitting in someone else's account instead of working inside your super fund. Payday super fixes that. Your contributions land within days, not months. They start compounding sooner. And over decades, that timing difference becomes serious money you'd never have seen otherwise. But here's the part that actually bites. The ATO's free small business super clearinghouse, the tool that thousands of small employers relied on to process super payments, shuts down on the 30th of June 2026. It's gone completely. If you work for a small business, this matters to you directly. Your employer needs a new clearing system set up before July, or your super could be late. It's worth a quiet conversation, not to cause drama, just to make sure your retirement money is actually landing on time every pay cycle. The super rate itself stays at 12%. That hasn't changed. But how quickly it reaches your fund? That changes everything. Now, while we're on super, the contribution caps just went up too. Your concessional cap, that's salary sacrifice, employer contributions, and personal deductible contributions combined, rises from $30,000 to $32,500. And your non-concessional cap jumps from $120,000 to $130,000. If you're using the bring forward rule, you can now put up to $390,000 into super over 3 years, as long as your total super balance is under $1.84 million. For anyone running a catch-up strategy close to retirement, that extra room is real money. The transfer balance cap moves up too, $2 million to $2.1 million. That means new retirees can shift an extra $100,000 into the tax-free retirement phase of super. If your balance is near that threshold, when you retire just became a financial decision, not just a lifestyle one. But before I get to the change almost nobody saw coming, there are 2 more you need to know about. The national minimum wage rises 4.75% from July. That takes it to $26.44 an hour, or just over $1,000 a week before tax on a standard 38-hour week. And this isn't only the minimum. Award rates increase by the same percentage. That's roughly 2.7 million Australian workers getting a real pay rise above the inflation rate, which was running at 4.2%. So this is genuine extra purchasing power, not just keeping pace. Now here's one for parents. From July 2026, the government pays 12% super on parental leave pay for the first time ever. That has never happened before. Super on government-funded parental leave. You don't need to claim it separately. It's completely automatic. And the paid parental leave scheme itself extends to 26 weeks, 130 days, for children born or adopted from the 1st of July. Picture this. You're 32, earning $70,000 a year. You take 6 months of parental leave. Under the old system, that's 6 months of zero super contributions from the government's side. Under the new rules, the ATO tops up your super fund directly. Over 2 or 3 kids and 30 years of compounding, that's thousands of extra dollars at retirement that simply didn't exist before. The system quietly started rewarding parents who take leave instead of penalizing them. For years, taking parental leave meant falling behind on super. Now it doesn't. That's a genuine structural shift. And if you run a small business, here's a bonus. The $20,000 instant asset write-off is being made permanent from July. No more guessing whether it'll be renewed each year. Small businesses with turnover under $10 million can keep instantly deducting assets under that threshold. Though like the standard deduction, this one still needs to pass Parliament. So that's 6 changes plus a bonus. But I saved the most controversial one for last. Division 2, 96. It received royal assent on the 13th of March, 2026. Quietly. And here's what it does. From the 2026-27 financial year, if your total super balance sits above $3 million, you pay an additional 15% tax on the earnings attributed to the portion above $3 million. If your balance clears $10 million, that extra rate jumps to 25%. You might be thinking, $3 million in super, that's not my problem. And right now, maybe it's not. But here's what makes this different from every other super tax in Australian history. It applies to unrealized gains. Your super balance went up on paper because the share market moved. You owe tax on that growth, even if you haven't sold a single asset, even if those gains completely reverse the following year. You are paying tax on money you never actually received in cash. That has never happened before in Australian superannuation, and it landed in law with barely any public attention. The $3 million and $10 million thresholds will be indexed over time, and couples can still hold up to $6 million combined across 2 accounts without triggering it. But if you've been salary sacrificing aggressively for 20 years, or you bought property inside super early, $3 million might be a lot closer than you think. So what does this actually mean for you right now? If your super is well under $3 million, nothing changes. The higher caps and payday super are working in your favor. Keep building. If you're approaching that number, talk to your accountant this financial year. Not next. The first assessment period starts now, and the way they calculate those earnings is more complex than any headline will tell you. And if you only take one thing from this video, make it this. 7 changes land on the 1st of July. 4 are automatic. The tax cut, Payday Super, the minimum wage increase, and Super on parental leave. You get those without lifting a finger, but 3 of them require a choice from you. The standard deduction, your super contribution strategy, and Division 2, 96, planning. Making no decision is still a decision. It's just usually the most expensive one. Most of this information is sitting on the ATO website right now, completely free, but it's scattered across dozens of pages written in language that's designed to make your eyes close. That's the whole point of this video. The 1st of July 2026 isn't just another financial year rollover. It's the year super got faster, tax got a bit lighter, and a brand new tax on large super balances appeared, while most Australians weren't watching. The rules changed. 7 of them. On one date. And now you know exactly how each one hits your money. If this saved you time, subscribing means you'll catch the next round of changes before they catch you.